Let's welcome in our next guest, Manish Sontholia of Motilal Oswal now joins us. Manish, thank you so much for taking out time for us. Last time when we spoke to you at the start of November, you said that valuations in the mid-cap are not particularly that good. You expect mid-caps to underperform. Now, after the recent correction, do you think valuations are decent enough to again go overweight on mid-cap, small-cap?
No, I don't think so. I think valuations in the mid-cap and the small caps will correct even from here. And still the valuations are not very conducive when you compare it with that of large caps. The difference in valuations is roughly 1:2.5 times. So if the Sensex or the Nifty is trading at maybe 16, 17 times, these may be trading at maybe 45, 50 times. I'm talking about the BSE 500. So still the valuations are not in sync with what should be. So I think mid caps and small caps still have a long way to correct from even from these levels.
In terms of large cap names after the recent correction, tactically large caps are looking better?
Yeah, large caps are looking much better simply because valuations are favorable. But even within the large caps, those who have elevated valuations will tend to underperform, and anything and everything which is cheap and not necessarily in sync with the growth that you have, So just to give you an example, company having a 10% earnings growth, and if it is available at 15p, that is likely to outperform vis-a-vis a stock which is 25% growth and may be available at 40p or 45p. So, and this is the trade which is not playing out only in India, this is the trade which is playing out all over the world. Value investing is giving way to growth investing, and growth investing is not going to work for some time.
Why do you think FIIs are suddenly, after the month of November, selling?
Yeah, so, what we have seen from 2008 to 2016 is that interest rates in the US have come down to zero, and US is the largest economy in the world. So, we saw a huge amount of dollar inflows into emerging markets, consequent to which the P multiples actually rose. Now with the zero interest rate regime ending and future hikes even in 2017 and 2018 quite possible in the US and looks very likely, there is again an exodus of dollars out of emerging markets back to the US. And here, as a result of which, we are going to see P multiples contract. So what is total shareholder return? It is dividend yields plus earnings growth plus percentage change in PE multiples, either on the upside or the downside. When interest rates came down to zero, the PE multiples expanded. So at 20p, what a stock, if they should be getting a 20p due to percentage PE expansion, we saw lofty returns more than the earnings growth. Now the reverse is happening. So, and it is all correlated with how the flows move, and that is what is prompting all the FIs to take out money. And on top of which we have demonetization. So on one hand we have earnings, wobbly for the next 2-3 quarters at least. And on the other hand, we are seeing valuations contracting. Double impact of which is resulting in a huge amount of outflows from the FIs, and this is likely to continue.
Is India still vulnerable to a lot of FII selling?
100%. So, we are not there yet as far as the FI selling is over. And I think they can continue to sell till about more clarity comes on the domestic front, either through regulations or budget, or something has to change, to change this perception as far as India is concerned.
Can Jan be a very big month for flows, because we'll get Q3 numbers, a run-up to budget or indication as to what's happening in the first week of Feb, and plus in US also we'll see the change at the top, which the decision came out in November. So it can be very, very a volatile month with great sort of allocation either coming to emerging markets or going towards developed markets.
So US is in a very sweet spot, all guns firing for the US, and there's every possibility that money is going to flow back to the US away from other markets. And we are not talking about developed markets to developed market switch, we are talking about emerging markets to developed market switch. And the entire emerging market space remains vulnerable, both on the sidings, on the debt side as well as the equity side. India is going to be no exception. If you look at the impact of demonetization in Q3 and Q4, I mean, this year also is a washout in terms of earnings. FY17, I'm building in anything like 2 to 5% earnings growth on the Nifty or the Sensex. FY18, what I was building as 18% growth is now got whittled down to 10%. So, there's a change in the system, and it's going to be good for the long term, but in the near term, you have got to go through the pain, and the economy should go through the pain like any other major change that happens. So, earnings gets whittled down, and P multiples contracting. So, both the things don't look quite good from a January point of view either. So, of course, how much of absorption in terms of DII inflows into our markets would determine what the net impact on the markets could be.
I'll just come to DII inflows in just a bit, but you mentioned that FY18 also you are expecting a downgrade. Some of the strategists that we have spoken to after demonetization say that FY18 numbers may not see any major downgrade. Why are you expecting a downgrade in the FY18 growth numbers?
I mean, this is hope as to how the economy might shape up, but there is some destruction of demand from FY17 and FY18 perspective, and there's some postponement of demand. I mean, mostly in the consumer staple space, and what is not consumed in FY17 definitely will not be consumed in FY18 just because the remonetization or cash flow situation in the banks, etc. Now, if you didn't have biscuits in 2017, you are not going to have double the biscuits in 2018 whenever that thing revives. So there is element of destruction of demand. Secondly, some postponement of demand. We really don't know how long that postponement of, like something like a cement. If you talk to dealers, etc., people are expecting revival only in 2018. I mean, we are not even talking of 2017 full revival. So prior to the general elections in 2019, people are expecting. So, the full-blown impact of both a postponement in demand and destruction in demand across all sectors, I think 10 to 12% is more likely rather than 18 to 20%, which we were working with earlier.
Traditionally, whenever US has done well or it's seen a big growth in GDP, India has also done well in terms of exports. Do you think this time it will be different?
I mean, that is correct, that emerging markets fall in line with what the developed markets do. But if you look at an EXIM trade, it's not very good. And if there was to be a shift in export out of China to India, from the point of view of imports into US and other developed markets, then obviously we are going to be beneficiary. But again, that is just based on hope, because if you look at the export numbers for 2017, they are nowhere close to the target that we had set out for ourselves. So to believe that anything drastic can change in 2018 when the new government comes to power in the US, and we are relying a lot on hope rather than what can be the real situation.
This time around, the currency would not favor exports or growth in exports, and some of the other emerging markets may become more competitive, even if US were to import a lot of goods and services?
Yeah, that is the conundrum, with the weakening of the Chinese yuan, our competitiveness is slowly getting eroded when we compare ourselves with China in many export items, and plus the depreciation of other emerging market currencies. Now, if we were to cut rates, and rates are also not going to fall in a hurry, we might mitigate that situation. But if, let's assume that rupee depreciation was to happen beyond 70, 72 to the dollar, we are going to import a lot of inflation into our country. So we are in a catch-22 situation as far as balancing exports and importing inflation. So to that extent, you are right, our competitiveness vis-a-vis large countries in the emerging market space, example, China, our competitiveness is going down.
Right. What do you said that the markets need a big trigger to stem these kind of outflows. Do you think the budget is going to provide that big trigger?
I hope so. The budget should give some sort of boost to the business environment, which has suddenly come down drastically, and the business confidence has suddenly come down very drastically. Giving some money in the hands of people so that they can go and spend. All this would bode well for them from an equity markets perspective. Any implication on the taxation front, if it is positive from an individual household perspective or the foreign portfolio inflows perspective or FDI perspective, should be looked at favorably by the markets. But all these things we shall only know when the budget comes out, but definitely this is what the markets are hoping for.
Right. You are saying leaving more money in the hands of the consumer. How would this happen? Because the GST has already happened. So less likelihood of much tinkering with the indirect taxes. What is your expectation when it comes to the direct taxes? How will the finance minister leave more money in the pockets of consumers?
Yeah, so one way is to lower the personal income tax. I mean, a very fraction of the population actually pay income tax, but nevertheless, it gives some money in the hands of the middle class if the taxes were to be lowered, income tax was to be lowered. Secondly, when the GST comes into the picture, there is going to be some positive wealth effect should the corporates pass on the entire benefits of lower combined taxes in the GST regime vis-a-vis the combined taxes which the companies are actually paying today. So this positive wealth effect should result in lower prices of products under the GST regime, even though that may not happen very near term, just after the GST comes out. But if the pass-through effect by the corporates is full and complete, I mean, that should result in better spending, or let's say bigger spending power in the hands of people.
But Mrs. Santhalia, could there be a negative surprise? There's already talk about what's going to happen when it comes to capital gains. First, they were, after what the Prime Minister said, people thought that perhaps there is going to be a long-term capital gains tax on stock transactions. Now, some rumors going around that maybe the short-term tax rate could be hiked. What are your expectations on this regard?
No, I think, first of all, the rate of tax may not be tinkered with. One year, securities listed on stock exchanges to avail of long-term capital gains, that can be extended to 3 years. That might happen. So, you'll have more people coming into the long-term tax ambit vis-a-vis the situation currently when, if you hold securities for just about a year, you don't pay any long-term capital gains tax. Short-term capital gains tax, I don't think they are going to tinker with. If they are going to do anything in this regard, they should just hike the STT, which is in the form of tax deducted at source, rather than tinkering with the short-term capital gains tax. Definitely, there is going to be an impact on volumes if STT was to go higher from these levels, but that would also be quite negative for the markets.
You think markets are already prepared that a little bit of tinkering on long term or short term may happen, and that's why it may not come in as a very big surprise as it would have come, say, if it directly came into budget?
No, markets are not at all prepared for all this after all the recent surprises and business confidence plummeting due to demonetization. Markets don't want this, and if this was to come, this will add to the negativity in the markets.
Right. Let's talk about some stocks and sectors. Let's just take an example of Asian Paints. I know you cannot give a call on Asian Paints because of your compliance, but this is something which we have discussed earlier, and you were quite positive on the paint business. With demonetization, with crude prices going up, you think next 1 to 2 years could be very tough for Asian Paints? So despite a good outlook, you would just want to avoid that name?
No. I don't look at it that way. We firmly believe that the paint sector is going to do well for the next 10, 20 years. We're not even talking about 1, 2 years. We are talking about the next 10, 20 years. So, and volume growth in the paint space is 12% in volume terms. Even in the worst of times, the full-blown impact of demonetization in the month of November and December, we are talking about half that growth coming in. So 6% volume growth is what the paint sector more or less has clocked in November, and 6% or 7% would be the volume growth as far as the paint sector volume growth in December is concerned. That's not a bad number to look at when we seeing this sort of disruption in trade. I'm pretty sure that volume growth is going to revive. It's a postponement of demand, as far as the paint sector is concerned and the entire building material space is concerned. Demand has not been destroyed, so you can postpone your painting of the house for some months, but not indefinitely. So it is how long you can see the growth and how much money they are going to make. But near term, due to P multiple contraction, can they correct? Obviously they can correct. And not only Asian Paints but the other two names as well. Entire P derating story can happen, but the earnings growth story won't be damaged. So again, from a total shareholder returns perspective, depending on your time horizon, dividend yield remains the same, earnings growth would remain the same in FY 18 or 19, but P contraction from a 50p stock could come down to, let's say, a 30p stock. I mean, at what P the franchise value comes out stark, and you would be more or less compelled to buy at those franchise values is what you need to decide. So if P multiples contract, your returns may be muted from, let's say, a 1 year perspective. But it depends on your strategy whether you want to flip in that interim 1 year period or you want to live through the journey of the 1 year and look beyond the 1 year if you want to hold that marquee name.
I looked at the 2009 data for the paint sector when crude prices actually went up so sharply. The EBITDA for some of these companies contracted by about 30 to 40% on a YOY basis. But then the companies managed to raise prices because demand was still high. This time around, because the demand is low after demonetization, that price hike can be delayed, and that's why the recovery may be delayed?
See, 1 or 2% price hike in a year when the disruption is more on account of technical reasons rather than something seriously going wrong on the crude side. I think all the three major players in the paint sector, have the pricing power and move the prices in tandem with the raw material prices. And that does not really hamper the volume growth story in a major way. So let's say a 12% growth, and if you look at the last 2 quarters, the volume growth has been including the lower base paints as well as the putties. It's something like 14-15%. So volume growth, just because raw material prices have increased and they increase the prices in tandem, I don't really think that the volume growth can get impacted from a medium term perspective. Maybe a year's perspective, 12% or 11% may come down to 8-9%, but I don't see anything lower than that.
Let's talk about autos and particularly two-wheelers. After the recent correction, two-wheelers as a sector is looking attractive?
Valuations are good. So today, everything and anything which is cheap will not see a dent in prices, no matter what earnings growth you will have. So, two-wheelers are cheap as a sector. And that is why they should relatively outperform the four-wheeler space, where valuations are expensive. But coming to the business side, volumes have got dented severely. Rural demand has literally collapsed, and there's huge inventory overhang in the system. So, you should be prepared in for a 40 to 50% decline in two-wheeler volumes when you compare it on a YOY basis for the month of November and December. And January doesn't look too good either from an inventory point of view, and production schedule should also get dampened. But P multiples are perfectly fine, and the combined impact of both the earnings degrowth side as well as the P multiple should mean that they should be better placed than the four-wheelers.
As far as two-wheelers is concerned, whenever the recovery would happen in volumes, better brands or stronger brands would tend to recover faster, which is what we have seen earlier as well.
So it's a 3.5 player industry basically, a 4 player industry. So all the brands are known. It depends on who is providing more value at what price point, and even the price points are not very different. So entry level segment, you have one player which is very strong. The sports segment, you have the other player. So market segmentation is clearly defined. Scooters, there is another player, but the growth rate in the scooter segment should broadly either continue at the same pace at which we have seen in 2016, or maybe slightly lower. But brand names won't really matter. It is, if it is the rural demand which is to pick up, you should have the entry level segment start to do well. And if it's the city segment or the urban segment, urban centric demand which picks up, then you'll have another player which is, basically the Pulsar, should start to do well. And scooters, basically it is one player which is major market share which they have. So I think urban looks better than rural at this given point in time. How and when the situation turns for the better in rural demand is what is going to determine the fate of many of these players.
Overall, organized retail business should do well. Any of the good brands that are present in the urban areas, there the demand recovery could be faster, because unorganized players also become, slightly, difficult to compete with the branded players.
True. December quarter will see a huge turnover jump for organized retail, modern retail, and this is going to continue even for the month of March. But valuations are totally out of whack, and I don't know what are we valuing, EV to EBITDA, turnover, because profit is not to be seen anywhere. But definitely the next 2 quarters are to be an aberration in the way retail has been looked at, so that maybe one of the sector which may outperform for the next 2 quarters.
It's only for the next 2 or 3 quarters where you expect this change. Don't you think it will become a trend in some time?
No, I don't think so, because many of the organized retail guys are actually tying up with the local kirana stores and mom and pop stores. So if you talk about Amazon India, they're looking at tying up with the local groceries who are going to supply them, and they in turn be the organized retail front end. So I think the business is going to come back to normal. It's not going to be a major disruption, and it can't be a disruption in India's context. And life will go on, but after a hiatus of 6-9 months, and I don't really think that Indian households are going to change the way they shop all of a sudden because demonetization will come through.
As far as NBFCs are concerned,
for the next 2
right, go ahead, Manish.
2 or 3 quarters, but nothing beyond it. So there's going to be a blip for 2 or 3 quarters, but nothing beyond that.
As far as NBFCs are concerned, they have seen one of the biggest correction. Also, they had their rally before demonetization. Are some of the NBFCs now looking attractive?
I would tend to think so, but again, there's a difference in opinion between what the market participants believe in this space. One is that the entire business model of NBFCs, 2 questions need to be answered: whether the business model of NBFCs have gone for a toss with the amount of money which has come into the banking system. So would NBFCs be viable as a business entity in a long term? And second is that there is going to be definitely help required from the RBI as far as regulatory environment for the classification of NPAs is concerned. They have given a 120-day window, but I think there could be something more that may be required on this front as far as the NPA, because there's a disruption, and obviously credit growth has gone for a toss, and NPAs will also move up. Valuations have corrected. So the differentiating factor, according to me, in the NBFC space would be those entities which are able to combine technology with finance, not the brick and mortar ordinary way of lending and borrowing. That is not going to be the future. NBFCs which have some analytical capabilities and They use technology to their advantage in credit appraisal. These are some of the entities which are going to see continued growth, but after some hiatus. So just to give you some numbers, of the total credit that we have in the system, roughly 15% of the total credit is extended by NBFCs. I think this number over the next 2-3 years should be closer to 18 to 19%, which means that there should be some growth. But the men are going to be separated from the boys, and you'll have entities which combine technology and big data analytics have an advantage over the ones who are doing ordinary borrowing and lending, which can become highly commoditized business.
Q3 and Q4 will be very important for NBFCs in terms of what's the write-off, what's the credit offtake. That will essentially give you a sense which of these companies can combine digital as well as make new products and try and uplift their credit growth.
True. In the tough times only you understand how the credit appraisal is working, or how the systems and processes of banking finance companies work out. And in good times everybody makes money and everybody can show growth, but in tough times the quality of assets which you own, the NPAs and the NIMs, if both and all of them move in sync, then it gives an idea about your processes and systems, and that is the thing to watch out for in Q3 and Q4 in many of the NBFC names.
Banks are now better placed, and that's why we are seeing lower correction for banks versus NBFCs?
Not really. PSU banks are going to be better placed in terms of treasury gains in FY17 compared to FY16. So that will mean that it's going to be a huge jump. We are talking about net loss figure for PSU banks in FY16 vis-a-vis now, with the treasury gains that they're going to see, you're going to see a net positive figure for FY16 for PSU banks. But these banks have a problem of, first, the growth, because system-wide growth is now in single digits and they are losing market share. And the second is the problem of NPAs, which may have tapered off, but again this whole demonetization is going to create a new round of NPAs. So I'm not too much in favor of the PSU banks, but private sector banks, you have good asset quality, you have good growth vis-a-vis the system-wide growth, but P multiples are high, so even they are correcting. So it's going to be taking a slightly medium to long-term call in the banking space if you want to really make money in this space. Nothing really is cheap, and valuation correction is underway, but I think earnings growth is going to be there for the PSUs and NBFCs, select ones, and PSU banks may have some more problems as we go into FY18 and 19.
But private banks, you think all of them will have NPA problems marginally, or some of them like Yes, HDFC Bank, which have traditionally not had NPA problems, actually may report decent Q3 or Q4 numbers?
What is decent needs to be defined, because entire disruption will see a spike in NPAs. How you are able to manage the NPAs through floating provision utilization, or selling it to ARCs and so on and so forth, all needs to be seen in context of the spike in NPAs that you are going to see. But definitely they are going to be much better placed, because not too much of project finance as far as the names which you took, working capital loans, which has also got hit in the month of November. December seems to be slightly better for working capital loans. Two-wheeler loans are a problem. You're not having collection efficiencies in that segment. And many of the private sector banks are heavily into CV financing, which is a trade which has got severely disrupted. So they'll have to handle each of their segments where they are financed to give an overall picture. But NPAs definitely would be on the higher side in Q3 when we compare it for Q2, even for the private sector banks.
Pharma and IT are two sectors which probably would not get impacted by demonetization. Recently, because of flows, you're seeing a sell-off even in those sectors. Do you think things would become normal over there?
Yeah, I would tend to think so, because first of all, these sectors, the names are cheap. They are not lofty valuations when we compare it with the rest of the consumer space, private sector banking space, overcrowded trade in those segments. So first of all, these sectors have relatively lower valuations. Secondly, these sectors have got lower impact on account of demonetization because you're dealing with exports. And third is regulatory hindrances, maybe slightly on the lower side as far as the pharma space is concerned. And we have got to see how the visa issues play out post the new regime in the US. But single-digit dollar revenue growth is something which is doable, even under the new regime. So, and valuations are quite comfortable. My sense is the IT and pharma space are broadly going to massively outperform rest of the the overvalued space in 2017.
Let's just look at each of these sectors one by one, and let's focus on IT. Valuations are attractive, earnings expectations are very muted. But is the street also forgetting that some of these IT names have traditionally been there? They have a global competitive edge versus some of the other players globally, and that's why whenever the growth bounce, they would be one of the biggest beneficiary of IT spending?
Now, that is the moot question where the markets are divided, whether the growth is going to bounce and whether Indian IT has the competence to take on the challenges of technological changes that we are seeing in the IT space, and that's not going to be visible in the next 2, 3, 4 quarters. It's a long-term transition which is happening, and whether the IT is able to adapt to the new changes or whether they are going to see people move on to new names and better capabilities. So that is a question which is yet to be decided. And that is what has resulted in lower prices to earning multiple, partly because people think that the new change cannot be adapted to by the Indian IT company. What is going to happen? Only time is going to tell. My sense is Indian IT can transition, and that is why I seem to be positive on the Indian IT space. And in the medium term, it is all about earnings growth vis-a-vis the valuations which you are having, and which looks quite comfortable. The growth and the valuation looks quite comfortable from a relative outperformance point of view. Whether absolute returns are going to get made even in 2017, I don't know. But vis-a-vis the rest of the market, IT looks good.
For pharma sector, it has to be very, very specific because of US FDA issue. We just saw what happened with DVs. One has to be very specific with the pharma sector.
Yeah, I mean, it's going to be very specific, but one observation out here is that when we compare FDA's import alert and 483s in 2016 vis-a-vis 2015, we are much better off in terms of number of 483s getting issued in 2016 when we compare it to 2015, and similarly for import alerts and warning letters. So my sense is that things may be tapering off regulatorily wise, and in 2017 should be better than 2016, which means that most of the pain in the sector for the time being may be on the declining side, and that gives hope that things should look up in 2017. And there's plenty of names both in the large cap and the mid cap space, and good names where valuations have got hammered and growth doesn't seem to be that bad. But yes, independent capabilities are going to decide how much of an market cap increase will each of these names see.
For pharma, one of the key arguments have been that global generic prices may be under pressure. But again, like IT, what Indian pharma has done into global generics, the pricing over there, do you think anytime whenever the prices of global generics recover, they would be again one of the first few beneficiaries?
That benefit will be available to the rest of the world as well. It's not that only Indian pharma companies are going to benefit out of it. And I don't really believe that Indian generic pharma players in the US used to overtly overcharge the prices out there. Business environment was conducive, and it's a free capitalist economy. If you have done your work well and you have done business as in a normal way, there should not be any major problems as far as collusion and cartelizing on the prices side. And I don't really think that drug prices are going to increase under the new regime. The way the commentary is coming out of the US as far as the drug prices are concerned, if they're able to maintain these sort of prices, it should be okay. We are talking about declining prices. And in each of our models, for the generic pharma companies, we're actually looking and projecting a decline in base business, the prices in the base business. So I'm not building in any increase in generic prices, at least for the next 1-2 years. We shall see actually what happens beyond that. But the base business and generic prices are only going to decline, not increase.
Just a last couple of questions, Manish, before we end, about the infrastructure space. For last 3 years, every year, most of the strategists point out that second half of next year, we'll see capex spending pick up. Do you see that happening after demonetization? Maybe once the demand picks up, the capacity utilization may increase, and that's why private capex would finally return?
Private sector capex is still 2 years away. And there's no question of private sector capex moving up in the next 1-2 years. Maybe, because capacity utilization is pathetic in the entire business. Each of the sectors, if you look at, yes, there's going to be a lot of money which is going to get thrown in the economy in the form of infrastructure spending, and this will exaggerate before the 2019 general elections. But this is one segment where there's going to be money there. So railways, roadways, seaways and waterways, these are some of the areas where niche players are going to get advantage. So there could be some state building which is happening in Telangana, Andhra Pradesh. So a whole lot of money is getting spent out there in building the cities and towns. So it's going to be select pockets, nothing in general, but certain segments are going to see a benefit of higher spending by the government, but private sector is 2 years away minimum.
How do you play the infra story, or where do you think in infrastructure, one can be overweight?
Play through cement. No, I will play through cement. I firmly believe, and this is corroborated through data. We had the Lehman crisis disruption in 2009, and post which government threw in a lot of money in the economy. And the cement demand for the next year after Lehman crisis actually shot up to 8%. Post demonetization, this demand has collapsed to 3%. The first half was very good, but post demonetization volumes have just crashed. And it's a postponement of demand. So 2018, I think cement valuations have corrected, can be a proxy to the infra spend that we're going to see.
Even if you look at the cement valuations post demonetization, they are slightly higher than 5-year averages. So still, do you think it's attractive, or just wait for Q3 numbers, Q4 numbers, and then probably go overweight on that sector?
We are broadly there. Yes, it can correct by 10% even from these levels, but we should look at the valuations in sync with where in the cycle are we. The cement cycle, the boom cycle has not yet started after 2008. It's in a limbo. So, at the beginning of the cycle, if valuations look favorably from a next 3-4 year point of view, from the point of view of EV EBITDA, which I think will broadly be there if the entire sector was to achieve 8 to 9 times EV to EBITDA, I think valuation should be okay, and we are broadly there. Maybe 10% correction could be there, but otherwise things are okay on the valuation side now.
Just a last word on the metals pack. Commodity prices have been on the higher side. Interested in any of the metal sectors?
A difficult call, to be honest, because infra spend by the US would mean stronger metal prices, but what is happening in China is also very scary, the entire debt situation and so on and so forth. And we are prone to seeing huge amounts of volatility in this space, and I don't really think it's a very suitable sector from a portfolio building and investments perspective. It's more of a tactical play, and I would tend to avoid it.
Manish, thank you so much for taking out time for us. But just before you go, for 2017, any Nifty targets? If not targets, what sort of returns you expect from here on?
I think, we are going to see much lower levels from these levels, and before we see some revival, just before the general election. I think 2018 there's money to be made in the markets and beyond, but 2017 is going to be quite tricky, and people may be surprised on the lower side as far as the levels of the Nifty. I don't want to give any numbers, but let's see how the entire thing plays out. 6 to 9 months looks pretty bad.
Thank you so much, Manish, for taking out time for us.